Highlight for today, early in the week, couple head fakes. Let's look at a couple. Let's look at a head fake that had a big order. When we look at our charts, you see this white line here. This white line is a big sell order. I think it was a 700 lot. It's a magnet. We're usually going to go up. I could talk about why it's a magnet in another session, but they go up, they fill it. A big buy order aggressively comes in and lifts that offer. And the key is, what does it do after? If it's not supposed to go get it and come back down, that's going to make a lot of people long, momentum buyers, or anybody long in here, mad. This shouldn't fill it and come back. So before it stumbles all the way down to here and gets you bearish, should be bearish in here based on that pattern. And we call it a head fake, where we're going sideways, sideways, jump. We're going to go up. No, we're not. And that becomes a bullish to bearish moment. We call it B to B. In this case, bullish to bearish. All right. And there's a whole reason and rationale behind it. We talked about it as it happens. What's really important in any kind of room that you're listening to people talk is to point things out that you understand, that you've come to understand, but you missed because you only got two eyes. So you want someone that's objective, that see things that you understand. Order flow, patterns that are going to tell you transitional moments at the right time. Look at this. The NASDAQ had a great one through 54. And what did we talk about? We were going to go through 54, and we finally did. We tried to right here back around 945. Look at this. Look at all those highs here in the NASDAQ. They get through it, and when they come back to here, what did I say? Look out below. That's pretty bearish. It's a head fake. It's got a lot of people that were long from here or back over there, thinking higher highs, and then it comes down, and it's like, shoot, maybe I'll just sell it here. Then it goes down to here. I'll just sell it here. I'll try to cover my long here or here or here, and they're getting more and more mad. Then you also get momentum longs in here, especially that these were the highs of the session. Who cares this is the NASDAQ and you trade the S&P minis? They're cousins. They affect each other. So when you get momentum longs in here and then they get stuck, they create those grapefruit eye moments where they got that dumb look, cross-eyed, and pretty soon they're going to have stitches. That's important to realize, and the patterns that matter in real time, the transitional patterns, that's what you want, to recognize it here that it's bearish, not way down here. And then down in the S&Ps, we had a great moment where most of the longs puked, and it was time to go up. But this NASDAQ finally, after it had a V-shaped recovery, they were going to take out these 54s. They just had to do it with less longs in the market. So pay attention to your transitional moments. They happen around the same time here in the S&Ps, head fake up to go down, and then through 54 to come back down in the NASDAQ. Two markets are both stock indexes. You don't have to trade both of them or the other one to pay attention to it. Always about relationships, cause and effect. You want, if you're bearish, to see that kind of pattern to get long stuff. If you want to get short, you want less shorts in the market, and you want as many longs stuck, because that creates less buying and more selling. Less buying and more selling makes price always have a higher probability to go down.